It's a scenario that I have watched play out countless times. You're anticipating a piece of news, an event, an outcome that has the power to transformationally drive values. And then so frequently I've watched people respond and invest based on that news or that event or outcome, and they'd be disappointed with the results. Either it went flat or in many cases actually lost a bit of value. Often, and ironically, good news can actually become the moment prices stop rising. It is understanding that expectations have been met. So today we're going to explore a foundational wealth principle. Buy the rumor, sell the fact. And in a moment, I'm going to give you a real world situation that I think perfectly illustrates it. But fundamentally, it's understanding that all markets are anticipatory. They're continually looking forward. They're evaluating what is coming next. And to invest in them, you have to become anticipatory. In the most powerful markets, stock market, bonds, crypto, precious metals, whatever it may be, again, they're continually looking forward. That news today has already become irrelevant. And how does that play out? So here's the real world example. And I could have used so many over the years when Bitcoin was being added to an exchange traded fund and so on. But I'm going to give you one that I think is very compelling. And that's Martha Stewart. So Martha Stewart had built a very successful lifestyle brand. And in the early 2000s, the government came after her for insider trading. Now, before we go further, I want to explain, I am not picking on Martha Stewart because it became very obvious. This wasn't about justice. This was, as the government is prone to do from time to time, take someone high profile and try to make an example out of them. Because when the dust settled, there was no evidence she had any knowledge other than taking the advice of her broker. And in fact, the transaction had a negligible impact on her net worth. In the end, it wasn't even worth the trouble. And in fact, she wound up with 5 months in prison. 5. How does that play in? So obviously, you can imagine her lifestyle brand. She is the creative force behind it. So while in prison, the value of the stock declined pretty dramatically. Would it be able to recover? Would it be able to survive without her? What would it be down the road? Would people forgive her? But in the months leading up to her release, the price began to appreciate. And it more than doubled. In fact, at one point, briefly, it was worth triple what the lows were. But then she's released. And so many people jumped in. And what happened? Over the next few days, the value of the stock dropped 16%. Why? Because it had already made its recovery. It had already appreciated based on the expectation. Now, the good news is for Martha and her investors. Long term, she just was more successful. And the company has done even better. But the point illustrates the buy the rumor, sell the fact. That if you're going to make that trade, you're not waiting till the event happens. You've got to step out earlier. It's a risk, but you've got to step out earlier. So here's a couple of key things for you to keep in mind, for you to assimilate into your strategy. First and foremost is, no matter how compelling or exciting the news appears to be, is it really integral to your wealth strategy, or is it a distraction? Because that's one of the biggest mistakes I have seen people make over the years. It's not that they're bad investments, but they really are just distractions from the core premise of building transformational wealth. But let's say you decide it does fit. First, recognize, yes, by being anticipatory, you're taking a risk of getting it wrong. But if you're going to, first off is, again, being anticipatory. Number two is positioning. You're not waiting till the event happens. You're not trying to get, and this is the one that is always challenging to get people to understand. You're not trying to get the best price because you don't have a crystal ball. You're just positioning yourself within your risk tolerances to take advantage of the potential of that event. Number two is as that event plays out, or what we'll call confirmation, this is your opportunity to adjust your holdings. And by adjust, it means if this isn't what you're considering a long-term position for your wealth strategy, if this was a temporary play, this is your opportunity to take advantage of that, take profits, hopefully, and move on to the next opportunity. And just as I said, you're not looking to get the absolute best price because you don't have a crystal ball. The other mistake on that is people holding on too long, trying to make just a bit more. Remember, the core theme is you want to make the most reasonable return. It's not about walking away from potential, but it's rather recognizing you'll never get it all, and often trying to winds up eroding what you did gain. That when you take the strategy, if the news confirms out, if you've got a return, if it's not a long-term hold, this is your opportunity to take the profit, move on, and look for that next opportunity, because that's what the rest of the market is doing. Because even if you do want to see it as a long-term hold, you'll probably see a lull, a dip along the way, because the rest of the market has moved on to their next opportunity. Anticipating events can build transformational wealth. It does involve a degree of risk, so you want to maintain your risk tolerances. But it's the recognition that good news or bad news is not about whether it has the potential to transform the market, but when you're anticipating them, how do you adjust your strategy in advance to either take advantage or minimize risk?